Welcome back to the Till. Today was a historic day. Kevin Warsh took over as the Fed chair. Five big takeaways. First and foremost, no change in rates, but the hawks are circling. Higher interest rates are potentially coming, right? The dot plot mystery is solved. They're no longer going to be submitting dot plots, right? The regime is going to have a task force on five major items, those being the balance sheet, data, productivity, jobs, the impact of AI, transformative, can't say that word, technologies, and central bank inflation and its balance sheet. They're going to be studying these things and providing this information to the 19 Fed governors, right? They're going to be tough on inflation, and he's going to get us back to 2%. And he had a little bit of wit, and he's not going to be saying at nearly as much and not forecasting things out there for us to have a direction on guidance. So he was firm in his stance that there'll be no more forward guidance, and he wants the markets to figure things out for themselves, which takes us back to what I feel is more of a Greenspan era time frame. So he's Greenspan tend to let his talking less talk and his actions actually speak for themselves. So when the Fed stops giving you clear multi-meeting roadmaps, it leads to uncertainty. And so the risk to short-term and long-term bond traders goes up, thereby the hedging ability in one direction also that goes away, right? So there's more risk in short term and long term of being right or being wrong on the wrong side of a Fed decision. The saying, don't fight the Fed, really goes back to those times when the Fed was not afraid to actually give a surprise. And if you're in the mortgage market, mortgages are based typically on the 10-year Treasury and mortgage-backed securities. So when investors can no longer lean on that forward guidance, they demand more compensation for that uncertainty. So, in other words, they don't sharpen their pencil nearly as much. Now, what they do is make predictions on potential individual reports on a shorter term basis versus longer term in some instances. So, what you're going to need to pay attention to is the economic calendars, what's being forecasted, and what the actual numbers work out to be. And always remember that bad news is good for interest rates, and good news is bad for interest rates. In the end, what also by no forward guidance and having dropped back in time to this Greenspan feel this year, there's going to be less scripting, more surprise. Under heavy forward guidance, the Fed would often telegraph their next moves. Now, Kevin Warsh is going to be minimizing the guidance each meeting, and each press conference carries real information and value, and the markets could get caught off guard. So more sensitivity to the data. So paying attention to that is going to be very crucial. And now you can see that in September, there's actually a 45% chance of a rate hike now, 36% in October, 43% in December. And then they also are potentially predicting a higher chance of a Fed hike in March. That's a second hike, not the first, right? So literally, the markets are now pricing in potentially 2 rate hikes based upon the fact that Kevin Warsh said he will get us back to 2% inflation. So all of these things are key when it comes to deciding what you want to do when it comes to getting a mortgage and locking in. So, a couple things to think about for you. I've been in business for 30 years, doing business in Virginia, Maryland, D.C. If you're not subscribed to the Till, please like, share, and subscribe. The Till stands for Truth in Lending and in Life. What I'm going to tell you right now goes against a lot of people's feelings, but I'm a firm believer if you can afford a house and you're buying within your budget, lock your loan. Okay? You're going to have a lot of people paying attention to this economic calendar and making bold predictions. Oh, I think that you need to wait till Friday. I think it's going to be better for rates, blah, blah, blah. All these things impact your wallet. If you take that advice, understand that you're playing and risking your bottom line dollars. Now, if you can afford it, if you're buying well within the risk, fantastic, go ahead and do that. When we were in the Greenspan years, we had the advantage of being able to flip from one lender to another. As a mortgage broker, I could lock with one lender and then turn around and submit another package and lock to another lender a couple days later and cancel the other lock. And that brought people to market as long as lender B got better than lender A. It made sense to make that switch. Be careful. You're going to have a lot of people saying, oh, we have a free float down policy. Just lock, right? If someone preaches the free float down option, first ask how the float down option is, what's the formula, right? There's usually a formula. It's the 30-day lock, add 5/8. That interest rate has to be better by at least a 0.25%, and then the client has to at least get an eighth better rate, and then boom, you got this float down. All these things had to occur, right? How can I track that as a consumer is your next question. The odds are you probably can't. When someone asks me, do I have a free float down option, I generally tell them no, but I'm always willing to ask the lender if they can do something better for you. While that might be considered a float down option, it's better, to be honest, in that the odds of you getting a better deal are unlikely. But in a Greenspan year, there's going to be a lot more volatility, so it may occur more often. Back in the old days, we would just flip to another lender. But here's the thing, technology has compressed our average closing time frame and date down to typically anywhere from 13 to 18 days, right? My average clear to close was 13 business days last year. So if that's the case, the odds of the market, you can't just go to another lender. That lender actually has to be able to give you the float down option because you're not going to have time to actually go somewhere else unless you're on a 30 or 45 day time frame. And there are fewer of those deals these days than there used to be. So in the old days, we used to be able to do a little bit more. As a mortgage broker, I have 20 different lenders, and you have other options. If you go to one source and they only have one 30-year fixed, they either have a float down option or they don't, but they're not flipping you to another lender, okay? At least with us, one credit report, we shop a number of lenders, and we have that potential option. But you should never, in my opinion, go with someone just because they say they have a float down option. unless there is a way for you to actually track it. And then the odds are you're going to call them up and they may say, oh, the market hasn't moved enough. Or maybe, if you're lucky, you get some type of flow down option, right? But the market's going to be more volatile. So the key is going to be, in my opinion, locking. If it's the right house and you can afford it, don't risk losing a house over someone trying to predict what the market's going to do, especially in the first 2-3 Fed meetings. Kevin Warsh is going to surprise us before the end of the year. That's my prediction and that's my promise. You mark my words on this video. If you're new to my channel, it's Truth in Lending and Life. Please like, share, and subscribe. My name is Kevin Warsh. I'm excited and wish Kevin Warsh much success. I hope he gets us down to the 2% inflation in full employment with the least amount of pain as possible. Keep in mind that just the fact of the fear factor is going to potentially push rates up a little bit, keep people on their toes, and that's going to do some of that work toward bringing down that inflation over the short term, especially if oil starts flowing through the Straits of Hormuz. My name is Kevin Warsh, owner of First Meridian Mortgage. Look forward to talking to you. If you have any mortgage-related questions, give me a call. I'll talk to you soon.